Welcome back. Let's start today's lecture with a quick recap what we have learned in the previous two lectures. The first lecture we discussed the content of this course. We will be learning basic concepts, accounting cycle, financial statements, bank reconciliation statement, rectification of errors, bill of exchange. Then I ask you to have these three items all the time: a calculator, a notebook, and a pen. Then I discuss 5 elements of accounting with examples: income, expenses, assets, liabilities, and owner's equity. Then we discussed the types of businesses: sole proprietorship, having a single owner; partnership, having more than one owners; and joint stock company, having unlimited number of shareholders. Then in the second class yesterday we discussed some accounting concepts which included purchases, cash purchases, credit purchases, purchases return or return outward, purchase discount and sale discount, allowances, sales, cash sales, credit sales, sales return or return inward, trade discount, debtors or accounts receivable, creditors or accounts payable, and cash discount. If you have joined this class for the first time, then you need to watch the first two videos which are available in the playlist of accounting course on my channel. In today's class, I'm going to tell you some basic accounting concepts uh, which are essential to understand the accounting, which are essential to understand why we do financial accounting. The number one and the most famous is separate legal entity. Accounts are kept for entities as distinguished from the persons who are associated with these entities. In recording events in accounting, the important question is, how do these events affect the entity? How they affect the persons who own, operate, or otherwise are associated with the entity is irrelevant. For example, when a person invests rupees 200,000 into business, it will be deemed that the owner has given that money to the business, which will be shown as a liability in the books of the business in the form of the owner's equity. In case the owner withdraws rupees 30,000 from the business, it will change the position and the net amount payable by the business to the owner will be shown only as rupees 170,000. The concept of separate entity is applicable to all forms of business organizations. For example, in case of a sole proprietorship or partnership businesses, though the sole proprietor or partners are not considered as separate entities in the eyes of law, but for accounting purposes, they will be considered as separate entity. So, in short, we can say that the business is different from its owners for accounting purposes. Okay. The second accounting concept is going concern. According to this concept, it is assumed that an entity is a going concern, which means that it will continue to operate for an indefinite period of time, and there is no intention to liquidate the particular business venture in the foreseeable future. On account of this concept, the accountant, while valuing the asset, does not take into account the sale value of assets. Moreover, he charges depreciation on fixed assets on the basis of their expected life rather than on their market values. For example, suppose that a company has just purchased a 3-year insurance policy for rupees 45,000. If we assume that the business will continue in operation for 3 years or more, we will consider the rupees 45,000 cost of insurance as an asset which provides services to the business over a 3-year period. On the other hand, if we assume that the business is likely to terminate in the near future, insurance policy should be reported at its cancellation value, that is the amount refundable upon cancellation. Moreover, the concept applies to the business as a whole. When an enterprise liquidates a branch or one segment of its operations, the ability of the enterprise to continue as a going concern is not impaired normally. The enterprise will not be considered as going concern when it has gone into liquidation. So, in simple terms, going concern means that the business will continue to operate in foreseeable future. Okay. The third concept is Money measurement concept. Money measurement concept. In financial accounting, a record is made only of information that can be expressed in monetary terms. In other words, no accounting is possible for an event or transaction which is not measurable in terms of money. For example, passing an examination, delivering lecture in a meeting, winning a prize, etc. These are the events, no doubt, but since these are not measurable in terms of money, there is no question of their accounting. Measurement of business events in money helps in understanding the state of affairs of business in a much better way. For example, if a business owns 1500 kg of stock, one car, 1500 square feet of building space, etc. These amounts cannot be added to produce a meaningful total of what the business owns. However, if these items are expressed in monetary terms, such as stock at rupees 24,000, car at rupees 300,000, and building at rupees 500,000, all such items can be added in a better way, and precise estimate about the assets of the business will be available. So for any transaction can be recorded. A transaction can only be recorded if it can be expressed in monetary terms. If we cannot express a transaction, for example, passing an examination, then we cannot record in the books of accounts. The next concept is cost concept. This concept is closely related to going concern concept. According to it, an asset is ordinarily entered on the accounting record at the price paid to acquire it, and this cost is the basis for all subsequent accounting of the asset. If a business buys a building for rupees 5 million, the assets would be recorded in the books at rupees 5 million, even if its market value at that time may be 6 million rupees. In case a year later the market value of these assets comes down to 4.5 million, it will ordinarily continue to be shown at rupees 5 million and not at rupees 4.5 million. The cost concept or cost model does not mean that all assets will be shown at cost. It has also been stated above that cost becomes the basis for all future accounting for the asset. It means the asset is recorded at cost at the time of purchase, but it may systematically be reduced in its value by charging depreciation. The next concept is uh, every transaction is recorded at the price paid for it. The next concept is the matching principle. Significant relationship exists between revenues and expenses. Expenses are incurred for the purpose of producing revenue. In measuring net income for a period, revenue should be offset by all the expenses incurred in producing that revenue. This concept of offsetting expenses against revenue on the basis of cause and effect is called the matching concept. The term matching means appropriate association of related revenues and expenses. In matching expenses against revenue, the question when the payments was made or received is irrelevant. For example, if a salesman is paid commission in January for sales made by him in the December of the previous year, according to this concept, commission expense should be offset against sales of December of the last year because this expense is incurred for producing revenue in December. On account of this concept, adjustments are made for all outstanding expenses, accrued revenues, prepaid expenses, and unearned revenues, etc., while preparing the final accounts at the end of the accounting period. The last expenses should be offset against the revenue in the same period. The last concept for the purpose of this lecture is realization. concept. According to this realization concept, revenue should be recognized at the time when the goods are sold or services are rendered. Sale is considered to be made at the point when the property in goods passes to the buyer and he becomes legally liable to pay. The following example will help to understand this point. Mr. A places an order to Mr. B for supply of certain goods. Mr. B sends goods to Mr. A 15 days after he has received the order, and Mr. A makes payment 10 days after the receipt of goods. In this case, the sale will be presumed to have been made not at the time of receipt of the order for the goods or receipt of payment, but at the time when the goods are delivered to Mr. A. So these are the some important accounting concepts. To the buyer. Okay, so these are the 6 very famous accounting concepts which we have discussed. The number one, the most important one is separate legal entity. The second one is going concern. The third is money measurement. The fourth one is cost concept. Fifth is the matching principle, and the sixth is realization concept. In going concern, in the separate legal entity, we assume that the business is separate entity than the owners. It means that we record the transactions from the point of view of the business and not the owners. So that's it for today's lecture. In tomorrow lecture, I will tell you some more about the accounting. Until then, goodbye and take care.